I'm recording now. I'm going to get ready to screen share chapter 20. Here we go. Hopefully you can see that. This is just the title page at this point, Process Costing, chapter 20. I will suggest that so far, I think everybody has kept their microphones off, but I've noticed that one or two popped on probably when a person was coming into the room. That's no problem at all. And in fact, I don't mind you popping the mics on for questions. I will point out somebody had a mic on in the earlier class this morning. And a thing that can happen is if you have the mic on, you might have things that you really didn't want us to hear, and perhaps we didn't need to hear, and perhaps they were a little distracting. Finally, I've been having a few connection problems. The class worked fine this morning, but I got in there about 10 minutes early, like I did this class today. People started coming in and I got knocked out. And so I had to get back in. And I did that right before class started. I had a class at another school I teach at earlier in the week that the whole class just dropped off, and then I could get back in there. So what I would ask you is, if that happens today, if for any reason I get kicked out, wait for me for the length of time you would if I were on the campus, like about 10 minutes. If I don't come back, just feel free to go ahead and leave. If I do come back, we'll continue. I'll tell you that even if I get kicked out, I will come back and finish, even if it's to an empty class. The reason is I'm recording now. I want a good recording of, roughly the first half of the material. So you'll be able to see this after this class is done. If for any reason we get kicked off and can't get back on, still at some point, I'll record whatever happens after we get kicked off, and it'll be up there too. Well, process costing is different than job costing. And so you can bet, we already set this up in the job cost chapter, but you can bet that something that will be a question for you, at least one, could possibly be more on the final, is to think about what types of operations use job costing and what type use process costing. It's rare that both would be reasonable. It is possible. For example, I tend to think job costing is better for cars because they're so expensive. Like, I think whether it's a dealer or whether it's an automobile manufacturer, they normally want to know their costs in every car. However, the cars are fairly standard at how they're assembled. And so I suppose if a manufacturer looked at individual cars as not expensive and almost like commodities for them, then they could use process costing. So ordinarily, I would think job costing would be a better choice, but process might work. There are a lot of cases, though, like individual legal cases for law firms, that just wouldn't be good for process costing because they're so individualized. There's no standard product. Every case is different. And so you'll see in here in a minute, we'll put up what the basic criteria is to be a good candidate for process costing. But these products will tend to be small and tend to be very sort of standard products that you can get a lot of different places. I would tend to use the example of screwdrivers and say that if you have 4 or 5 different sizes of screwdrivers, if you go buy one from one hardware store and somebody else goes buys one from Walmart, you're not going to see much difference. So we tell you in this chapter that process operations are used for mass production of similar items. So you see how a car might fit, might call it mass production of similar items, but just the cost of it alone will probably make the car a better choice for job costing. We say there's a continual flow of sequential processes. So one problem I have with the way different textbooks are written is almost every student I teach understands English. It's usually a requirement in classes that, just the places I teach, it's usually a requirement that a person not necessarily have English as their first language, but at least can kind of understand it. But yet we come to a statement like the second bullet, and I think it's an English statement. Everybody knows what every word is, but to sort of see it put together, sometimes you don't quite see what they're getting at. So when we say continuous flow of sequential processes, well, back in the batch chapter, there was sort of a continuous flow, but it was a flow of different jobs. So the processes weren't sequential. There were different jobs going on at different times. But here, like we'll say, for example, that some of the authors' examples in this chapter, like a blending department. And so the blending process, or blending process 1 and then blending process 2, they go on in sequences. And then there might be an assembly process, and then there might be a cutting or stamping process. And then we come to this point where this is a point where I think automobiles would be a tough sell, but possible. Even if they are fairly standardized, it's hard to imagine large volumes made at once of similar products. And let me just clarify, when we are talking about cars, I could possibly be lured to the idea that a very standard, basic, low-level model of any car might well be standardized. I'll tell you one I'll pick on just because I know that company's standard car. The Toyota Yaris is one of the most common brands of Toyota, and or makes, and it's an inexpensive car compared to other Toyotas. You don't have a lot of choices with it. If you go and buy a Yaris, you're limited to a few different colors. You're limited to a few different packages. And so they can produce a lot of those at the same time because they could sell a lot. On the other hand, if you take like Toyota's flagship car, the Avalon, usually those are very custom. You can choose seating. You can choose leather seats or other seats. You can choose a lot of different colors. And so, that one, it might be a lot harder sell to even imagine thinking of manufacturing that one as as a process cost. But here are examples that the authors give you. I mean, this is a very possible 5-point question. Also, when I was telling you that I imagine not having an extra credit question, but having something like the question on the last test where you could just throw up a lot of answers and get like a point per answer and have a lot of good choices. This is a perfect place for that. If I said to you, okay, here's a 20-point question, throw up to 20 types of products that are made that would fit job costing, and throw up to 20 types of products that are made that would fit process costing. You have to have at least one of each, but you can name as many as you want and just keep getting credit. Well, this is something that you might just, want to think of a lot of different companies that would be eligible for both. And so we see some here. Some of these companies I'm not even sure you're aware of. For example, if you look at General Mills, I grew up in a different time than you all. I see some things that are still common. Like when I was a little kid, the commercial that you might have seen, because it seems to keep showing up on YouTube and stuff, a commercial that used to just be hilarious to people in the era I grew up in was Life Cereal. Had this picture of a mom pushing, it's like a little video of a mom pushing cereal in front of 3 kids. And the 2 bigger kids didn't like it. And I mean, they were afraid of it. They hadn't tried it and didn't want to, but they said, oh, let's give it to Mikey. He'll eat anything. And the little kid eats the cereal and loves it. And then the bigger kids realize their mistake, that they should have eaten it too. And like Life, there were that Count Chocula and Frankenberry are both good cereals. And I know I've seen them lately in stores. but they went with a television show at the time. And so they were sort of like popular because of the relationship to the television show. My point to Life and Count Chocula and Frankenberry is I don't know if you realize that they're manufactured by somebody. I can't remember if they're General Mills or not, but a lot of cereals are. So where you might look at all these different cereals, whatever you ate as children, and if you're still eating them, whatever you're eating now, you might think of them as individually manufactured, but they're really a very small number of companies that make a lot of brands. Um, Especially in our COVID era, and this book came out right before COVID. So in our COVID era, we do start to see Pfizer in a different light. But to me, Pfizer and the other companies, Johnson and Johnson and Bristol Myers, that made vaccines, they have a lot of different pharmaceuticals they do, and some of the basic pharmaceuticals would well be, good process costs. Other complicated and rarer drugs might be job cost. So I really could see a company like a pharmaceutical company making both. I mean, having some things that are process cost and some things that are job cost. Procter and Gamble's another company like General Mills. This one I'm a little more familiar with. I told you all just a few minutes ago when I was talking about checking out Southern Ohio to see how the grass was greener when I was, a graduate student. This company's headquartered in Cincinnati, Ohio, and that was where I was studying. So I actually wound up living in Columbus and taking a job at a national firm there. But when I was studying in Ohio, I was studying near Cincinnati, and Procter and Gamble was a company that we would get visits from, and some graduates from Miami went there. And it's one of these companies that's always in the Fortune 500, but you never think of them because they make all these products. I'm going to name some that aren't theirs, but they make these products like Colgate toothpaste and Palmolive dishwashing liquid and some others. And for a lot of reasons, they just don't seem to be products that would be made by the same company, but they are. And so all of these products, the ones I named, Colgate, Palmolive, things like that, they would all be good for process costing. Why they called Coca-Cola soft drinks on the bottom left and Pepsi beverages on the top right, I have no idea. Don't get me wrong, I would fit either of those into either category. So I don't think it's wrong to call Coke a soft drink. I don't think it's wrong to call Pepsi a beverage. But what is wrong is to imply that those two aren't in the same business when they are. I'm not familiar with Carr myself. Hershey's, you may know that not far from Shepherd, just up across the Pennsylvania border, there's a nice park up there, Hershey Park. And at one time, Hershey was, a Harrisburg area company headquartered up there, fairly small compared to other chocolate companies. And that's when Hershey Park got going. These days, it's part of a big organization like most candy companies have gotten to be. But the different products that Hershey would make, different kinds of chocolate bars and stuff like Hershey's chocolate and Crackle bars and Mr. Good bars and whatever else they're doing, they would be good candidates for process costing. And I don't know this brand of orange juice, but most of the brands of orange juice would be as well. And this just wets your whistle. If this is my question, think of the ones that would think of good candidates for process costing and think of good candidates for job costing. Don't by any means limit yourself to these 8. Think about all the other types of processes that would be good for process operations here. So one thing that's interesting, and I think I told you all this in the job costing section too, or maybe it was back in the basic management accounting chapter. I really liked the idea as a college student, and I like it, now as a professor, of diagramming and looking at how an operation works, trying to match the accounting that's going on to the actual flow and way an organization goes. So we're going to take a few moments and diagram a standard process, and then we'll apply in today's discussion some concepts about how to cost the processes. So just if you've already read the chapter and are kind of thinking through what we're going to do, I imagine today is going to be talking about these processes and talking about how we um, establish costs and relate costs to processes. And then the next class is probably where we're really going to get into the accounting and looking at the journal entries for how we journalize those costs. But here, each process is a separate production department. It's unclear to me, and it's not important now. I'll say this. I don't know what's going on in this particular company. They have said that every process is a separate department. I don't know if it's just lucky for us that this hypothetical company really has all these departments, or if really what they're trying to say is, look, when you're diagramming processes, you should really almost think of them as separate departments. But that last statement is true. So even if they were all part of a same department, you would want to think of them as separate processes and account for them and track costs that way. Notice there's nothing different from job costing insofar as each process applies direct labor, overhead, and direct materials to move each product to completion. And then the final process takes the finished goods and makes them ready for sale. The exhibit you see here at the bottom is your book, is out of your book. It shows the raw materials first, and it shows in this example, they're peanuts, dried fruits, and chocolate. They go through the roasting department, the blending department, and then become a finished goods inventory. I'll just relate this because it's probably something you've seen, and some of you might even think more broadly than I will about how it relates. But you've probably noticed that when you've bought things now, like if you've bought chocolate bars, you probably see something in the fine print that says, because it's not that fine sometimes, that says this product was made in a manufacturing facility where there were peanuts. And I'll usually see peanuts put that way. I won't see, for example, this product was made in a facility where dried fruits were used, or this product was made in a facility where chocolate was used. I guess for the people who are allergic to chocolate and allergic to dried fruit, they would like to know that. But I think it's been documented that some people have a dangerous allergy, and not a small number of people, fairly large number of people have a dangerous allergy to peanuts. And so they kind of need to know if peanuts have been used in any, or even if products that don't appear to be peanut products have touched peanuts. And so I don't relate it in any other way that since peanuts is one of the ingredients, this organization probably somehow has to make us aware that peanuts are used in the operation, even if they're not used in one particular product made there. Hang on just a second, just a quick diagnostic thing. Okay, I wanted to check something. I'm going back to screen share now. So this is a comparison of the processes through and in a way, you kind of hate to use a word to describe itself, but we're going to look at how things flow. If I keep the word process out, we're going to look at how things flow through a job cost system and how things flow through a process cost system. We just finished chapter 19. And notice how they start the same. Way over in the left, you have direct materials, direct labor, and overhead for either system. Whether you're making big goods or small goods, you have those three things. But what's different is you get into the job order system, and we have work in process inventory. We saw it in our homework. And the work in process inventory is jobs that are being produced. Whereas at the bottom, we have processes that are being produced. And it doesn't really mean anything different to a business, but in terms of accounting for it, or even assigning cost to it, we actually had jobs, individual jobs, and the inventory related to those jobs, and we kind of knew who they were ultimately going to be sold to. But in these processes, the work in process relates to what happens in a department, and it's separated, at least at this point, and as far as we can tell, from who's going to buy it at the end. What I meant by the statement, as far as we can tell, is we, the management accountants or the people who are studying management accounting, aren't told in any way who's going to wind up being the person that buys at the end. That's not to imply that at a good company, the company management and operations, or sort of the head management team, if they didn't know it, they could figure it out. You know, if they would see orders for items, and they would see items being made, and they could figure out who those orders were for. I'm just simply saying, we knew in the management accounting system, we knew who the orders were for under job costing. We tend to not know in process costing, and that doesn't matter to us. Now, notice we're tracking these costs, and that's what we're going to be talking about in the next few minutes. We're tracking these costs by roasting department and by blending department, and we're trying to do it per unit. We use something called equivalent units of production, and you'll see that soon. But at the end, we're going to use these different costs that we've kept up with and calculated to come up with our estimate of a cost per unit. And that's similar to what we did in work in process, in job order costing. It kind of just brings us back to the reminder that in both cases, keeping up with our costs is going to help us either figure out how to price or serve as a check on how our operations are going and whether those operations are efficient or not. So now we're going to go ahead and compute some of these process activity costs. And we're going to think about weighted average. So I was setting up your homework in the last few days. And there are two main ways we can track process costs. And they sound very familiar because there's some familiar concepts with what you did in Accounting 201 with inventory. So one of the ways we could do it is first in, first out, FIFO. Some of the lesson discussion is in FIFO, and a few of the problems I could have assigned were in FIFO. There are a lot more problems to be assigned in weighted average, and I think in process costing, weighted average is more common. So for the most part, we're going to teach weighted average here, as if these processes are kind of, the costs come into them on kind of a weighted average basis, as opposed to a first in, first out basis. But you'll see both. At the minute, we're going to be talking about weighted average. So we like to say there are going to be 4 steps in the way we're going to demonstrate process costing using weighted average. First, we want to figure out what the physical flow of the units is. Then we're going to figure out equivalent units of production. Now you're going to see here, and I mean, it might be a little fuzzy to you, but the words equivalent units of production should start to set out for you that if we have just stuff in blending, we don't have a completed product. We couldn't sell it to anybody. But we still are trying to act as if, like, for example, if we have 10 units in blending right now, and blending is 1/3 of the process, we might look at it as though we have 3 1/3 equivalent units. That's an oversimplification, but it gets at the idea that we know these things aren't done, but we're trying to look at them as if they were done. How far along are they in the process? How close are they being done? But if this could be an end product, how many equivalent end products do we have with it? And the reason that's going to be important is because of number 3. If we can come up with equivalent units of production, then we can put costs on them. And costs are just plain important anyway. Like, I mean, I hope one of the things you've really come to believe in management accounting is that a company has to have a really good handle around its costs. Separate from this, I'm just digressing for a minute. I like to read financial news, and just, because I'm interested in it. And so sometimes I'm just interested in what, a top accountant or a top financial planner has to say, or lawyer. So at one point I was reading this story within the last year, and the person who was speaking, I forget, like, it was a written story. So the person who wrote the article, I can't remember exactly what their profession was, but I kind of think, I know it was in somebody who consults with companies about how to be successful. And this person might have been an attorney, might have been, a CPA, said, one of the biggest problems companies have, a lot of companies have good ideas. What keeps some of those companies from being able to live their good idea and turn their good idea into a great product is they lose track of their costs. I mean, just think about this on a small scale. If you go and you get a paycheck from your work, the total paycheck feels like a lot of money. So if you stop and get dinner on the way home, it might feel like, oh, I really didn't spend much of that at all. I made $150 and I spent $10 on dinner, so I still got 145. But think if you went and did that every day of the week, what would happen by the time you got 7 days down the road? Just on dinner alone, without anything else you even were thinking about buying, you would have shot most of that check. So the person was saying, look, I tell businesses, count every paperclip, count every penny you spend. Worry about where every dollar goes. Well, that's enough for financial advice right now, but as it relates to management accounting, they're in the same boat. They don't want these costs to not be traceable to a way to bill for them, because anything they can't bill for, they're going to have to pay out of their profits, which could, of course, run their profits negative. So computing this cost per equivalent unit, that just on its face, that's a strong statement. But we are going to be trying to relate the costs in number 3 to the equivalent units in number 2. And then number 4, we saw this in job costing, where at the very end, we were reconciling applied overhead and actual overhead. We always have to assign and reconcile costs. In other words, if we're putting something in the accounting records, which we're going to do in the next class, not today, but in the next class, if we're putting something in the accounting records, what we put in the accounting records is going to have to reconcile to what we computed as costs. Otherwise, we're either way overblowing the costs, and that can produce a problem too. We haven't focused as much on the problem that can produce. Let me just spit it out. if we overestimate our cost, we won't be in that problem where we shoot all of our wad of money and don't have anything left, which most businesses have or many have. But we'll have the problem of we may overprice our stuff. We may think we need to charge more money than we do, and it might keep us from being competitive. Okay, so here's an example of our physical flow of goods. We have here beginning work in process, and we can't tell, at least I can't, from the picture what kind of one of those raw materials it was, but we have beginning work in process. Notice then it's not raw materials. We had some beginning work in process. We added some things to it. Together, the 30,000 we had beginning work in process, the 90,000 we started during the period, we add them together, and then that makes 120,000 units that we have to account for. So now we want to make sure that the 120 units that we're supposed to account for is in fact the number of units we did account for. So then we come up to the units completed and transferred out. Notice they have this in a nice equation, and it does work that way. Beginning work in process plus units started gave us 120 units to account for. If we accounted for 100,000 of them because we transferred them out, that better mean we have 20,000 in ending inventory. And then our 120,000 accounted for is the same as the 120,000 we need to account for. And so on the bottom, all you see is really, in some ways, just a rewrite of what was up at the top. We could show the roasting department reconciling its units to account for 120,000, units accounted for 120,000, and then they're just done. And what I'll say is I don't see reports that don't balance. So like when you're out there in the work world and management accountants produce stuff like this, I'm sure first drafts don't balance. But if they don't balance, they just need to go back and like spend some time getting it right. And by the time it's right, it comes out balanced. As I say, I haven't seen it, but if I saw a company that went ahead and just, produced a report like this and units to accounted for was 140,000, but units accounted for was only 120,000, and they just let that go, that to me would be a company that's going to have problems someplace. All right, so now we're going to compute equivalent units of production. So one thing that becomes important, they're not really talking about it on this slide, but you can kind of see it happening, is ordinarily you'll be told in a problem when units are applied to the process. This is a separate comment from whether the general physical flow is weighted average or whether the general physical flow is FIFO. So for example, in this case, you see beginning work in process, and then you see under it that direct materials are 100% complete. Normally, if you read a problem on Connect that you've been assigned, it will tell you when direct materials are put into the process. And them just telling you about direct materials alone doesn't mess up that FIFO versus weighted average thing. It's usual. It's not always true. And sometimes the authors will just change it up a little bit because they can. But usually direct materials are added right away. So in most processes, when the company is ready to make some stuff, first thing that happens is the manager of the department, let's say it's blending, that's going to start working with raw materials, just requisitions raw materials. We saw that in job costing. We're going to see it again here. They just requisition the materials they need right away. They don't requisition them generally as they need them. They requisition them right away. But see, the flow after that, when those raw materials are actually used and made into end products, that can go throughout the period. So it may be that all that stuff's not happening FIFO. So in this case, you would have been told raw materials are 100% or direct materials are 100. Let me rephrase. The way the language would go is direct materials are added at the beginning of the process. And they might say direct conversion costs are added 2/3 at the beginning, 1/3 throughout, or they might say conversion costs are added evenly throughout the process. Now, units started this period usually have nothing to do with that. So you see here in the second column, if I can call them columns, I'm not really using that percentage complete thing as a column. I'm saying beginning inventory is the first column, unit started is the second column, and that's usually a separate statement. But we will be told what the units completed and transferred out are. Now, it's a coincidence that the number here is 100,000. I'm just saying it's 100,000 because the authors told you it was, but they could have picked any other number. But it's no coincidence that below that, the percent complete for anything completed and transferred out is 100%. So that's not a coincidence. That's going to happen every time you do something where whatever's completed and transferred out of this department into another one is 100% complete. I suppose at an upper level, real process or graduate level management accounting class, and I had that. I guess we did stuff like that. It was a long time ago. You might just sit around a table and try to think about weird cases where you might transfer something out that's not quite done and the next department might finish it. But that's not an ordinary thing, and it's not anything we hid in principles of accounting. At the end of the period, you'll be notified. It's not really very easily something you can calculate yourself. So you'll be notified what percentage of the conversion costs are done and what percentage of the direct materials are done. Do let me give you an example of these conversion costs, though, so that you understand. So normally, the whole process in a manufacturing process, the whole process is to take raw materials and turn them into finished products, right? That's the process. I mean, you have humans along the way that are significantly involved in the change. You may have raw materials blended together, but without the human involvement, what you tend to have is a bunch of raw materials. So if we're saying that beginning inventory was 65% converted, that means all the other costs that weren't raw material costs, any machine costs, where you throw it into the blender and the blender blends it up, and it takes a little time and electricity to run the blender. Those costs would be conversion costs. Any of the costs of the humans, maybe pouring the right mix in, if there are humans that are sampling these at the end to make sure that they're made with proper quality. Those would all be conversion costs, anything that turned the raw materials into finished goods. And so this stuff that was beginning work in process, usually the authors would have to tell you in a problem, there's 65% of the conversion costs that are in here. 65% is done. And for ending process and ending work in process, it's a general rule that it's less because, the beginning work, I guess it's not quite a general rule that beginning work in process and ending work in process, ending's less than beginning. But I guess the point I'm trying to make is the ending work in process ordinarily will still have a lot to go as a general rule. Some might be close to being done, but a lot of it would have a lot to do. So it's no surprise to me that they're saying here, ending work in process is only a quarter complete to conversion costs. Raw materials added right away. We requisitioned everything we needed. But in terms of the humans and the machines that are going to be involved in converting that to finished goods, we still have a lot to do. So here's the formula for units of production. Equivalent units completed and transfer out, plus equivalent units in work in process. And so here's a little example of how we could calculate this for the roasting department. And this goes with the stuff you saw on the last slide. The roasting department completed and transferred out 100,000 units. Those are 100% complete. So those completed units are equivalent to 100,000 finished units. But look at the ending work in process for direct materials. Haven't even gotten to the conversion yet. We have 20,000 units. They're 100% complete, but only 20,000 units. So the equivalent units of production here are only 20,000. So we multiply 20,000 times 100, come up to, that's 100%. So that comes up to 20,000. And we have 120,000 equivalent units of production in direct materials. But in conversion costs, they're not added at the beginning like the direct materials. So here, our ending work in process is only 25% complete. Therefore, we only have 5,000 equivalent units of production. Here, the math, if that was a little hard to follow, here the math was the equivalent units of production